Okay, so you want to own an oil well. A gusher erupting out of the ground, black gold spraying into the sky while you stand there in awe of what you just found. A check arriving in your mailbox every single month for the rest of your life, for doing essentially nothing, because the oil just keeps coming and somebody else pumps it out of the ground for you. Instant, generational wealth, the kind of story where a poor farmer drills a hole on his own land and wakes up a millionaire by lunchtime. Passive income, straight out of the earth. That is the dream, and it is not entirely wrong. The problem is what happens between the dream and the reality. Because the single most famous oil discovery in American history didn't just make fortunes, it also destroyed them, sometimes the same fortune, within the same year. Because the majority of the oil a typical modern well will ever produce often comes out in its first 18 months, not spread evenly across a lifetime. And because in April of 2020, the price of a barrel of American oil didn't just fall. It went negative, meaning producers were, for one surreal day, paying other people to take their oil away. So let's start with the myth, because you have to kill it before anything else makes sense. Most people think owning an oil well means owning a hole that produces a steady stream of oil, and therefore a steady stream of money, for as long as you own it. That is technically true for a tiny handful of wells, and it is almost irrelevant to how the economics of oil production actually work for the vast majority of oil wells drilled in America. Here's the honest answer. An oil well is not a factory that produces a consistent product at a consistent rate. An oil well is a rapidly depleting asset, racing against its own decline curve, at the mercy of a commodity price that can move more violently in a single week than most stocks move in a year. Understanding that one distinction, a mailbox money machine versus a decaying, price-exposed asset with a shrinking clock attached to it, is the difference between owning an investment and owning a countdown timer that happens to pay you while it ticks. Let's start with what it actually costs to get in the door. The cost of drilling a well varies enormously depending on what kind of well you're talking about, and that variation is the first thing most people underestimate. A shallow, vertical, conventional well in an established onshore field might cost anywhere from a few $100,000 to around $2 million to drill and complete. A modern horizontal well in a shale play like the Permian Basin in West Texas, the kind of well that actually drives most new American oil production today, typically costs somewhere between $6 and $10 million to drill, complete, and hook up to production infrastructure, and that number climbs even higher in more complex or deeper formations. Offshore wells are an entirely different universe of cost, with a single deepwater well in the Gulf of Mexico commonly running into the tens of millions of dollars, and in the most complex ultra-deepwater projects, occasionally past $100 million, before a single barrel has been produced. Before any of that drilling capital gets spent, you need the rights to drill in the first place, and that means dealing with mineral rights, which in the United States can be owned entirely separately from the land itself. A landowner or mineral rights holder typically leases those rights to an operator in exchange for an upfront lease bonus payment, often calculated per acre, plus an ongoing royalty, typically somewhere between 12.5% and 25% of production revenue, paid for as long as the well produces. In an active, competitive drilling region, lease bonus payments alone can run into the thousands of dollars per acre, and a single drilling unit can span hundreds or even over 1,000 acres, meaning the leasing costs before drilling even starts can rival the cost of the well itself in a hot enough market. And then there's the ownership structure question, which most people chasing the mailbox money fantasy never fully understand until it's too late. There are, broadly, two very different ways to own a piece of an oil well. A royalty interest entitles you to a percentage of the revenue from production, with no obligation to pay any of the operating costs, and critically, no liability for what happens to their well later. A working interest, by contrast, entitles you to a share of production revenue, but also obligates you to pay your proportional share of drilling costs, ongoing operating expenses, and eventually, the cost of properly plugging their well when it stops producing. Working interests are the ones marketed aggressively to individual investors through drilling partnerships and syndications, often specifically because of an enormous tax incentive. Intangible drilling costs, the portion of a well's cost tied to labor, fuel, and site preparation rather than physical equipment, can be deducted against ordinary income in the very first year, in some structures covering as much as 65 to 80% of the total investment. That tax deduction is real, and it has driven a huge amount of individual investment into working interests over the decades. It is also precisely why so many individual investors have ended up personally liable for costs, and eventually clean-up obligations they never fully understood they were signing up for. So before your well has produced a single barrel, you are already three things: exposed to a commodity price you have zero control over, committed to a well that starts losing production the moment it starts making any, and, if you bought a working interest rather than a royalty interest, on the hook for a share of costs and liabilities that don't end when the oil stops flowing. Let's say you clear all of that. The well is drilled, it's completed, oil starts flowing into the pipeline. Now here is where it gets interesting, because this is where the business starts to look nothing like what you pictured. The first thing you learn is that production from a modern shale well doesn't arrive as a steady stream. It arrives as a spike, followed by an aggressive, unforgiving decline. A typical horizontal shale well can lose 50 to 70% of its initial production rate within the first 12 months alone, and continue declining sharply for the next couple of years after that, before eventually settling into a much slower, longer tail of production that can continue at a fraction of the original rate for a decade or more. This is such a defining feature of shale economics that the entire industry is sometimes described as running on a drilling treadmill, because any single well's high output period is so short, an operator has to constantly drill new wells just to keep total production flat, let alone growing, which means the capital requirements of this business never really stop the way people assume they will after their well is paid off. The second thing you learn is that none of this matters nearly as much as the price of oil itself, a number you have absolutely no influence over as an individual well owner. Oil is a globally traded commodity, and the price of West Texas Intermediate crude, the American benchmark, is set by a combination of global supply, global demand, OPEC production decisions made in a room you'll never be in, and geopolitical events on the other side of the planet. A well that pencils out beautifully at $70 a barrel can turn into a money-losing liability at $30 a barrel, and the well itself hasn't changed one bit. You didn't do anything wrong. The number that determines whether you make money changed underneath you, the same week it changed for every other well owner in the country. There's a third mechanism worth understanding, because it explains why the oil business has produced some of the fastest fortunes and fastest bankruptcies of any American industry. The boom-bust cycle isn't a bug in this business, it's the defining feature of it, and it has been since the very beginning. Let's talk about Spindletop. On January 10, 1901, a well drilled on a small hill near Beaumont, Texas, struck oil in a way nobody in the industry had ever witnessed. The well, later known as the Lucas Gusher, blew out with such force that it sent oil shooting well over 100 feet into the air, and once it was brought under control, it was producing an estimated 75 to 100,000 barrels of oil a day, a single well that briefly outproduced every other oil well in the United States combined. Word spread almost instantly, and Beaumont, a sleepy town of around 10,000 people, was flooded with speculators, investors, and fortune hunters within weeks. Land that had been worth pennies an acre was reportedly changing hands for thousands of dollars an acre in the immediate aftermath, and companies were formed and sold on nothing more than a rumor of proximity to the discovery, some of them for wells that were never even drilled. That boom made real fortunes. Companies that exist to this day trace their origins directly back to leases taken out during the Spindletop rush. But the same discovery that created those fortunes also destroyed a huge number of others, and the mechanism that destroyed them is the exact same mechanism that has destroyed oil investors in every boom since. Overproduction crashed the price. So much oil came out of the Spindletop field, so quickly, from so many competing wells drilled right next to each other with no coordination and no restraint, that the price of oil in the region collapsed from around $2 a barrel before the discovery to as low as 3 cents a barrel within about a year, an almost total wipeout in the value of the exact product everyone had rushed in to produce. Speculators who had paid enormous sums for leases and drilling rights based on the fantasy of the Lucas Gusher discovered that having oil, even a lot of it, was worthless if the price of oil itself had collapsed under the weight of everyone else's oil hitting the market at the exact same time. That pattern, an incredible discovery triggering a rush of drilling, followed by oversupply crashing the price and wiping out the very people who rushed in, has repeated itself, in different forms, roughly once a generation ever since. And the most recent version of it happened within living memory of almost everyone watching this. In the years leading up to 2020, American shale producers had drilled aggressively across the Permian Basin and other major shale plays, financed heavily by debt, betting that oil prices would stay high enough to service that debt while the drilling treadmill kept running. Then, in the spring of 2020, global oil demand collapsed almost overnight as the world went into pandemic lockdowns. At the exact same moment, Saudi Arabia and Russia briefly flooded the market with extra supply during a price war between the two countries. Storage capacity across the country, especially at the critical delivery hub in Cushing, Oklahoma, filled up so fast that traders holding oil futures contracts approaching delivery had nowhere to physically put the oil they were contractually obligated to take. On April 20, 2020, the price of the expiring West Texas Intermediate futures contract did something that had never happened in the history of the benchmark. It went negative, settling at roughly negative $37 a barrel. For that one contract, on that one day, producers weren't selling oil for a profit. They were paying buyers to take it off their hands, because the cost of storing it themselves, if they could even find storage at all, was higher than the loss. The fallout from that period rippled through the entire industry. Whiting Petroleum, one of the largest producers in the Bakken shale play in North Dakota, filed for bankruptcy in April of 2020, one of the first major shale casualties of the crash. Chesapeake Energy, a company that had once been one of the most aggressive and celebrated pioneers of the American shale revolution, filed for Chapter 11 bankruptcy in June of 2020, listing debts of roughly $7 billion, brought down by the same combination of aggressive debt-fueled drilling and a commodity price that refused to cooperate. Dozens of smaller producers across the shale patch followed the same path that year. None of these companies had suddenly forgotten how to find or extract oil. The oil was still there. Their wells still worked. What changed was a price they had no ability to control, and a debt load that had assumed that price would never do what it just did. It's worth pausing here to note what both of these stories, more than a century apart, actually have in common. Spindletop and the 2020 shale bankruptcies weren't caused by bad geology or bad engineering. Both were caused by the same structural feature of this entire industry. The thing that makes an oil well valuable, the oil itself, is a commodity that every other well owner in the world is also trying to sell at the same time, and there is no mechanism in this business that automatically prevents everyone from producing too much at once and crashing the price on themselves. This is the part of oil well ownership the fantasy never shows you. The risk is not really about whether you find oil. Modern geological surveying and seismic imaging have made dry holes far less common than they were in Spindletop's era, at least in well-established, well-understood formations. The risk is almost entirely about what the oil is worth by the time you're able to sell it, and how fast your specific well is declining while you wait to find out. There is also a slower, quieter risk that doesn't show up in any single dramatic price crash: what happens to a well after it stops producing. Every oil well, eventually, needs to be properly plugged, a process that involves sealing the wellbore with cement to prevent oil, gas, or contaminated water from migrating and polluting groundwater or surface land. Depending on the depth and complexity of the well, plugging costs can run anywhere from tens of thousands of dollars for a simple shallow well to well over $100,000, and in some deep or offshore cases, into the millions. If you hold a working interest, that plugging liability is legally yours, proportional to your ownership share, for as long as you own it, and it doesn't go away just because the well stopped being profitable. This obligation has created a genuine, growing crisis across American oil country: orphan wells, meaning wells whose original operators have gone bankrupt, dissolved, or simply vanished, leaving no solvent party legally responsible for plugging them. Government estimates have put the number of documented orphan wells across the United States in the hundreds of thousands, with some broader estimates of undocumented, aging, or abandoned wells running well over 1 million, and the total cleanup liability associated with properly plugging all of them has been estimated in the tens of billions of dollars. When an operator goes bankrupt owing plugging obligations it can't pay, those costs frequently end up falling to state governments and taxpayers, because the oil company that was supposed to pay for it no longer legally exists. If you own a working interest in a small, aging, or marginal well, you are, in effect, one bankruptcy away from either paying that plugging bill yourself, or becoming part of that same national statistic. Layered on top of both the price risk and the plugging liability is a newer, structural risk reshaping how this entire industry gets financed. A growing number of major banks and institutional investors have pulled back from financing new fossil fuel drilling projects over the past several years, citing climate-related lending policies and long-term energy transition risk. Whatever your view on the reasons behind it, the practical effect for an individual well owner or small operator is a shrinking pool of available capital and, in some cases, higher borrowing costs, at precisely the moment the drilling treadmill requires you to keep spending money on new wells just to keep total production from collapsing. Put all of that together and you start to see why the list of people who have made durable, long-term fortunes owning oil wells looks so different from the list of people who got in during a single dramatic boom. It takes real capital just to drill a single well, before you've secured a single acre of leasehold or a single dollar of production revenue. It requires understanding, going in, whether you own a royalty interest with no cost exposure, or a working interest with real, uncapped liability attached to it for as long as you hold it. It requires surviving a commodity price you cannot influence, set by decisions made by foreign governments and global demand shifts you'll read about in the news at the same time everyone else does. And it requires all of that holding up long enough to recover your capital before the well's own production curve declines past the point of being worth operating at all, a race against time that starts the day the well is completed and never really stops. So if you do decide you want to own an oil well, understand what you are actually signing up to buy. You are not buying a hole in the ground that quietly mints money for decades while you do nothing. You are buying a rapidly depreciating asset, tied to a global commodity price you cannot control, that front-loads most of what it will ever produce into its first year or two, and that comes with a plugging and clean-up liability attached to it for as long as you own the working interest, whether the well is still profitable or not. The gusher is not really the business. It never really was. The gusher is the myth, the vivid, unforgettable image that pulled fortune hunters to Beaumont in 1901 and still pulls individual investors into drilling partnerships today. Everything that actually decides whether you make money happens somewhere else, in a global supply and demand balance you'll never see coming, in a decline curve written into the rock before you ever drilled into it, in a plugging bill waiting patiently for the exact day the well stops paying for itself. The oil is almost a cost of doing business, dressed up as the entire point. The real asset was never the barrel. It was the timing, the price, and the discipline to get your capital back out before the ground took it back.